What are the best dividend stocks for riding out a recession? Well, right now, stock markets are trending down as the bear market continues. Crypto is basically cooked. Tech stocks, done for. And while those will come raging back when the monetary conditions change, the truth is that if/when a recession actually hits the markets, we will probably have further to fall for the markets. And having income-paying stocks in your portfolio can provide some relief during those times. Those dividend payments can help you to offset any losses in your portfolio. And if you reinvest those dividends, you can, of course, get more bang for your buck while prices are cheaper. So let's explore some of the best dividend-paying sectors of the stock market. First, let's talk about mining stocks. Traditional mining stocks are expected to strengthen if a recession hits. So commodities themselves, such as, metals, have always been seen as something of a safe haven in times of both economic and political turmoil. Both the S&P GSCI Precious Metals Index and the S&P GSCI Industrial Metals Index actually surged following the Russian invasion of Ukraine earlier this year, outperforming the S&P 500. This is due to the prices of nickel, copper, aluminum, and tin all reaching record highs due to supply chain fears. We also have increased demand from the growing electric vehicle and renewable energy sectors. Now, the miners across gold and silver and industrial metals are expected to return very high profits from predicted supply shortfalls and high demand for materials. Here's a great example of what is happening right now. So demand for silver is up 16% this year, while supply, it's up only 1%. So we have the situation where higher profits are going to equate to higher dividend yields for investors. Yields are generally trending higher, with companies like Southern Copper offering 5.4% and gold miner Sentiment at 7.6%. But this does differ across the industry and which metals being mined. Metals such as copper and lithium are also expected to be in demand for years to come, given the drive towards, of course, again, the electric vehicle industry. Thus, the future looks very promising for metals and for metal mining stocks, as we see the world moving away from fossil fuels and more towards electric vehicles and renewables. Now let's talk about banking. Ew, I know, but this sector has long been a popular dividend payer. Following the last recessions, the global financial crisis of 2008, the 2020 pandemic, we see major banks around the world having significantly de-risked. Not all of them. Looking at you, Credit Suisse. Many have focused on creating a much safer business model and, of course, a better environment for the industry to operate in. Now, here are a few key metrics that I want to outline here for you about how banks in the US could be well positioned going into the next recession. So the rising interest rate environment will actually support higher margins across lending for banks. Banks have a pretty sound loan growth situation right now, even in the face of the global pandemic. Tighter affordability and better lending criteria have also created better loans for banks, thus reducing the risks of defaults. Banks also have much stronger balance sheets. Loans to total asset ratio are actually down from 62% back in 2001 to less than 50% today. And banks have significantly more liquid assets, 41% today versus 27% back in 2001. Plus, they're all too big to fail anyway, obviously. So a consistent dividend is likely to be guaranteed in the future from banking stocks, with yields typically ranging between 2 and 5% in the US, and banks in other countries, if you're willing to venture out beyond US shores, offering potentially even better dividends, depending, of course, on your risk profile. Now, before telling you about some real estate trusts, some energy producers, and of course, essential goods companies, I just wanted to let you know about my weekly crypto investor newsletter. It's called Wealth Mastery. It's absolutely jam-packed full of alpha on the crypto space. We talk about altcoins and airdrops, NFTs, DeFi tutorials, market analysis, and much, much more. Join our 50,000 weekly readers by signing up for free using that link down below in the description. Now let's talk about energy producers. They are likely to do well in any upcoming recessionary environment because of the world's dependence, of course, on energy, particularly oil and gas. With the underinvestment in renewable energy right now, the world is still heavily reliant on the use of oil and gas for manufacturing, for home heating, for electricity to power, well, everything. Unlike fiat currencies, you simply can't print more energy either. when you need more of it. You actually have to go out and get it. Recent events such as Russia's invasion of Ukraine and the hangover of disrupted supply chains from the global pandemic lockdowns have all seen energy prices going significantly higher around the globe over the last couple of years. Rising energy prices mean energy companies are experiencing some pretty nice profits these days. So much money, they do not even know what to do with it sometimes. Big profits, of course, mean large dividend payouts for shareholders. This is in part why old man Warren Buffett has gone big on energy stocks. Berkshire Hathaway has bought a 21% stake in Occidental Petroleum Corp this year, and that's worth approximately $11 billion. That generates them $800 million a year in dividends. Dude. And Occidental's price also up 111% this year, which is just a win-win for Buffett, of course. Energy producers are some of the highest dividend payers in the whole market, so it's definitely worth not ignoring them, offering a return of almost 6% annually on average. ExxonMobil, the largest oil producer in the United States, for example, has increased its dividend payment for over 25 years consecutively. That being said, I do prefer to invest in the renewable energy companies myself. My stock portfolio is pretty heavy on renewable energy providers, and the dividends from those companies are often pretty damn good too. So if you don't want to invest in oil and gas, check out the renewable energy providers. They're also interesting investments. But in such an environment, of course, it is hard to ignore those big dividends coming in right now from oil and gas energy producers. Now let's talk about REITs. Firstly, what is a REIT? Real estate investment trust. These are companies that own and manage income-generating real estate. Now, REITs own buildings such as warehouses, maybe hospitals, maybe data centers, shopping centers, and sometimes, of course, even residential real estate. They tend to pay higher dividends than the average stock, which could help balance out your portfolio during a recession. It also gives you great exposure to the real estate market. Now, REITs are required to pay at least 90% of their income to shareholders as dividends. For example, if they make $1 million in income, it would pay out $900,000 as a dividend to its shareholders. Now, what makes REITs an interesting investment is this. Their debt levels are the lowest they've been in over 20 freaking years. Inflation has been increasing actually equity in their properties, and the income has actually helped to pay down the debt on their portfolios. The combination of low leverage and low interest rates that we saw in 2020 has allowed all those REITs to build up their interest coverage ratio. Now, this shows that REITs now have an easier time servicing their debt than probably ever before, which is very interesting, right? Now, something that's crucial in the high interest rate environment right now is that REITs are here and they're giving you access to those markets and they're ready to withstand the upcoming recession and will be well placed to take advantage when the recession brings inflation down as well as interest rates. Now, my personal stock portfolio contains a range of real estate investments. There are loads of good options out there right across the range of sectors. Again, whether you want to invest in hospitals or data centers or whatever, and across economies, right? If you want to invest in Australian markets or American markets or whatever. Finally, let's talk about essential goods companies. These are companies that produce and sell essential goods and are probably going to do pretty well in a down market comparative to everything else. These are items that people can't live without in their everyday lives. That's food, household goods, hygiene products, that kind of stuff, right? As a result, these kinds of companies are able to maintain stable growth as they do not follow any particular market cycle. Having companies of this kind sitting in your portfolio will potentially help to mitigate the impacts of a recession, as these companies tend to grow steadily regardless of market conditions, due to their ability to make consistent profits because people always need toilet paper, right? These are very reliable plays when it comes to paying out regular dividends as well. Most consumer goods companies within the S&P 500 have actually raised their dividends every year for the past 25 years through all the major crises that we faced in the markets, right? In recent months, we've even seen hedge funds move big time into these consumer stocks. We also see, for example, Ray Dalio's Bridgewater Associates moving into Procter & Gamble, moving into Johnson & Johnson in a big, big way. So there you go. Dividend stocks, guys. Love them. Okay, that's it. Subscribe now. See you next time.